Welcome to an introduction to candlestick charting. Candlesticks have been used for many, many years. In fact, years ago they were used actually by Japanese rice traders to chart trends in prices of rice. But for our purposes, we'll talk about how they can be used, one, to spot bullish and bearish reversals in the market, also to provide entry and exit points for traders. We're going to show areas to place protective stop loss orders once you might be in a position. And these can also be very helpful to find early signals for trend reversals. Remember, a lot of the indicators and oscillators are a bit lagging in nature, but this can actually give an early sign for those reversals. So when we look at chart types, on the left side we see bar charts. Those are your typical open, high, low, close bar charts. On the right-hand side are going to be really your candlestick charts there. And so on a bar chart, the top of the line is the absolute high. The low for the day is going to be the very bottom of that line. And then there are notches on the left side and on the right side. What those really refer to, the notches on the left side, that's the opening for the day. And on the right side, that's going to be the closing price for the day. Now, on candlestick charts, it's the same information, it's just shown a little bit different. And so here we say it's a candle. But the wicks of the candle represent the actual highs and lows on the day. Now the close, and this is where it's really different between whether the close is higher than the open or lower than the open. Typically you'll see a green, we call that the green body of the candle, and when we see the green body, that's a positive candle, meaning that the closing price was higher than the open. Typically technical analysis traders, they want to see strength and they want to see things close higher than they open, and so that's why we say that's a positive candle. On the right hand side we look at a red body, and that's where the opening price, in this case it's all the way near the top, the opening price was there and the closing price was lower than the opening price, and therefore it's a red candle or a bearish daily candle. And so traders look at this and they say, well, it actually showed a little lack of conviction during the day and didn't show as much strength because it couldn't close at or higher than the opening price. One more thing too before we move on, I'll just put the notations back up here. Just understand, I refer to these as daily candles, and typically traders use these on daily price charts, but just understand that each bar or candle represents a period, and so one bar on a daily chart represents 1 day's price history. Weekly charts is 1 week, and 5-minute charts, each candle would represent 5 minutes in time. So really it just depends on your time frame that you're trading on which of these that you'll actually use. Some of the most popular candlestick patterns are listed here, and the reason why I listed these can be reversal patterns, or ones that I like to look at. For example, the Doji. The Doji is that top one. It really is a cross, and you'll see there's little variation between the open and the close. You can see dojis when there's a little bit of a lack of conviction in the markets, and markets might be pausing or reaching an area where a trend really seems to stall. Now, the next day or the next period is important in any of these candles because it kind of validates the pattern, but a doji is really a pausing in the market. We have the bullish hammer, and you'll see that at the very end of downtrends, that can be an indication the trend is actually turning from down to up. Shooting star bearish, that's the end of an uptrend. Bullish engulfing and bearish engulfing. Now you'll notice on the bullish and the bearish engulfing, sometimes candles are shown in red and green, other times they're shown in black and white. And so for the bullish, when you see the white candle next to the bullish engulfing, that's saying that the top of that body, the closing price was higher than the opening price, and that's why it's a white candle or an open candle per se, as opposed to filled in. So let's take a look at a couple of examples in this introduction to candlesticks. And the first one we'll take a look at is the bullish engulfing reversal pattern. And so in the blue circle down below, you'll notice that the green body is engulfing entirely the red candle right before it. And so hence the engulfing nature of this. And so if the one body is completely on the top and on the bottom, broader, or you could fit that left side, that red body right into the green body, that engulfs the previous bar. And so here we see a downtrend. We see a bullish engulfing reversal pattern form. And when you see this, this is a potential trend reversal pattern. Now, one of the nice things too about technical analysis, it gives you a spot that if you're wrong, you can get out and take a small loss. So what you'll typically do is draw a line underneath that pattern. That would become a support area. If price were to close below that support area, you might get out and take a very small loss and just say it didn't work this time, but my idea was correct. For the bearish engulfing pattern, it's the opposite. Now the red candle, you notice, fully engulfs the green candle within that blue circle. Again, when we do these, we can draw a resistance area. Now for here, this is one of those things too. Someone who's long this position might not necessarily exit right away, but it might be an opportunity to to draw up your stop or tighten up your stop here. But certainly if price continued to close above that resistance area, you would say, well, it's not a reversal, and the bullish trend might continue. They're not up 100%, no pattern is, but I thought it's important to show one that doesn't work out perfectly all the time, and this is kind of a good indication of that. But this is a bearish engulfing reversal pattern. One of the ones that's very powerful is the bullish hammer reversal, and you'll notice within the blue circle down below, you have a candlestick pattern with a small body and then a long wick. It looks almost like a hammer, and it can be said you're kind of hammering out a bottom. And so typically you'll see that at the bottom of downtrends, and like the other patterns, the nice thing is you can draw a support area. So if price did close back below that, if you took a position and got long or entered a long position here, if it closed below that support area, that dotted line, that would tell you, hey, maybe get out, it didn't work this time. And on the flip side, the last one I'll show in this real short introduction is a shooting star bearish reversal. And so here it's really the hammer upside down, but this is indicating that the uptrend might be ending. And once again, we can draw our line, that resistance area above the pattern, and if price were to close back above there, it might negate this pattern. This is a really interesting one because a lot of times downtrends, as I said, oscillators and indicators can be a little bit lagging in nature. But these, you may see these, sometimes they're called blow-off tops or shooting star reversals if you're using candlesticks, but they can be a really nice early indication that the uptrend is losing steam. So important things to know. As always, make sure and manage your risk and enter stops and limits. Hope you enjoy this, and best of luck to everybody. Thanks.